This is like multifamily 15 years ago. Just not a lot of people actually know about it, know how to do these deals, how to maximize the value of it, even if you don't keep the property and it gets rescinded, or the seller gets the right to get it back. You're still getting great returns. So that's really why we're focusing on this today. And John, you're the right guy to help share that. Now, you brought up, you do have a lot of boots on the ground. You also brought up something before we started talking here, and I think it's really important. You're not allowed to do a full due diligence in terms of what kind of carpet is there, what's the interior look like. Sounds like there's a lot of limitations, and I know this is always with the auction markets. Can you speak a little bit to the, well, higher risk, higher reward, but the risk of not being able to go in the properties?
Yeah, so in one of our purchases was a structure, a home in Corpus Christi, Texas, and we paid $14,000 some change for that house, about 1,500 square feet. We thought we'd be able to renovate the property. However, the day of the auction, I got a call from the law firm saying the owner's son is wanting to bring the money in, and it's too late. They can't, we won't accept it. So expect to hear from them. They're planning on redeeming it. So I reached out to the owner, even, I don't know if it was the day or the next day after the auction, began having great dialogue with her. Interesting case. She lived in the home, raised her family there, and left the house like 6 years ago and moved across the street with her father and never went back in the house. All her possessions were in the house. I got pictures. We spent a pretty good amount of money just getting her possessions out of the house. Long story short, we began the demo. She agreed to sell us her redemption rights. This house is homesteaded. It was her homestead. And that's a whole nother area we don't have time to talk about today. But these taxing jurisdictions, in my opinion, they don't do their job. They're supposed to go out every 3 years and physically inspect the property. That's not happening.
That never happens.
No.
Zillow. That's how the comptroller around here does their tax evaluations.
Oh my gosh. So this place was pretty poor shape. We ended up, you're not allowed to go inside the property before the auction. So you could buy a pig in a poke, and we've got 1 out of 10. However, I spent a couple $1,000, hired a crew to put a tarp over the roof. There's 4 or 5 holes in the roof. And then we removed a lot of sheetrock, ceilings, floor, subfloors, and did a full inspection of the structure, and then determined that it's unfortunately a tear down. So we got $14,000 in the purchase. We're paying her $250 for her right of redemption. She's going to, I've seen a draft. We haven't executed it yet, but one of my managing partners, by the way, is a real estate attorney in Austin, 44-year practitioner whose father was a dean of law at University of Texas from 1947 to 1977. So I got a pretty sage real estate attorney on my management team. He's drafting that document. He found out from the title company that they will issue a title policy if we get her to sign her right of redemption, and she's willing to for $250.
That's amazing.
We are going to end up spending $5 or $6 grand in the demo, and still be under the value of the dirt once we do the demo. And I want to do the demo before January 1 because the new assessed values will come out as of January 1. And we want it to be, I've already protested the value, got it down from 100. Oh, that's where I was going. They had this property assessed at $127,000 on the tax rolls. Vacant, dilapidated, and I protest. I got it down to 77,000, but next year we'll get it down to the value of the dirt, which is about 30,000.
Yeah, especially if you got to remove the structure that the entire value is based off of.
Exactly. Yep.
So this is a unique situation. Has this been out of 10%? Is this kind of the par for the course, or more of a unique situation?
When my experience and my focus is very unique because we're again not focused on improvements. We're focused on commercial raw land acreage. So it's a rare event.
Okay. But it's very possible that it could occur more often if you were looking at more of the homesteaded and residential properties.
And
maybe not.
If we were to buy a commercial piece that had a laundromat in the past, had some environmental issues, that's all part of our underwriting. Do our diligence up front. As far as on the land, I'm a former realtor. I feel comfortable trespassing on the property, right or wrong.
I'm an attorney. La 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 la.
You have a little more opportunity to inspect on unimproved property than you do improved property, I guess is where I was going with that.
Okay. In terms of your own business, is your target to sell off the raw land, to develop it, or to find some developer that just wants a joint venture? They do the build, you get part of the big chunk of the benefit.
Yep, all the above. However, our business model is primarily buy it 20 to 30 cents on the dollar and sell at 70 cents. We don't want to really hold out for retail because of the nature of raw land and dirt. It's not as fast moving as improvements. So we want to price it below market value so we can buy and sell and build up our fund, grow it accordingly. But we will hold on. I've got two 2.6 acre parcels that are in the pathway of some pretty good development down around Rockport in Aransas County that are contiguous. So it could be a 5.2 acre parcel. And we got it at very nice spread on this acreage.
Are they close enough to the markets that residential home builders is still a good prospective buyer? Because even with where real estate's been, it's a hot market to build neighborhoods right now.
Absolutely. In fact, there's a whole nother area of property called struck off. So when it goes to auction, if nobody bids it, and it happens a lot of times the opening bid exceeds the value. So there's no buyers if anybody does their diligence. And those get struck off to the taxing jurisdiction. And there's a lot of inventory available. You can negotiate. They can take less than the amount of taxes. So there's a lot of potential for infill lots. And that's part of what we're going to grow into is acquiring some of these struck off properties in inner cities where we can put in tiny home, projects. And there's certainly a viable market there for acquisitions.
Makes sense, especially if you're in the hill country or a high cost area. They're desperate for housing. So doing these tiny homes, easy, cheap way to get involved. You can have companies like Boxable that will literally deliver the house. All you got to do is put up the walls.
Yes.
I absolutely love the business.
Yeah. We bought one in Williamson County. I'm sure you're familiar with Williamson County. It's where the new Samsung plant came in Taylor. We're about right up the road from Taylor. We bought a nice lot, and shocking, Taylor was like on the way to nowhere before Samsung put it. No, you can get out to Rockdale and East Texas on that highway. But anyway, yeah, it's gone crazy nuts. A town by the name of Bartlett, just north of Taylor, is having $400,000 subdivision homes coming in because of this Samsung project.
Wow. Well,
we bought one. We bought a lot, half acre in this Williamson County for $9,200, and it's on the tax road. It's worth $45,000 to $50,000 all day long.
I mean, if anybody is like thinking about these numbers, something's worth $100,000, you're spending 20. Your goal is to sell something that's worth $100,000 for 70.
Mm-hmm.
Like, here's where this massive level of opportunity is. But let's talk about what you need. You need the boots on the ground. You need to have the education, knowledge, and experience, and you need to have the capital. And that's where setting up your own fund to be able to do this. But if you're wanting to get more involved with this, whether you're looking to create the boots on the ground or you're looking to be a funding resource, I definitely suggest everybody that is interested in this asset class to reach out to John Burlett. John, do you have an email that I can just, if you don't mind, I'll throw it in chat so people can reach out to you
John,
directly.
John at core, C-O-R-E, tax deeds, plural.com. And the core acronym is Cash Out Real Estate. So this is really a short-term play in the grand scheme of things. We don't want to hold these properties very long. We want to generate some profits and distribute them within the first 18 months is our goal. And we're coming into being able to put some of these properties on the market here. And the first one will have the 6-month redemption period over in November. And it's we've got a lot of upside in it. Do I have time to go through that business split?
Yes. Yeah, please do.
Okay. So we got to set up where the management entity, which I manage, takes a total of 6% of the profits. 2% when we buy the deed, the property, 2% to manage it during the holding period, and then 2% on the sale. So that's our incentive. Then the passive investor, the investor in this core tax deeds crowdfunding offering, receives a 12%, the first 12% of the profits go to the passive investor. At which time, and some profits got to be generated, of course, before you get your 12% pref. But once we generate profits, and we feel like that's going to happen sometime in Q2 next year, then we split until the passive investor is made whole. They get 60% of the profits. Management team gets 40%. Once they're made whole, we're going to a 50-50 split on the profits. So it's pretty generous, in my opinion, based on the amount of work. You're putting in capital, we're putting in the work. We're taking 40% of the profits until you're made whole, and we take 50% of the profits.
Let me ask you this, because I think the structure makes a ton of sense. Are you having a repayment of the investors so that preferred return, which 12% is quite high, that will continue to go down where eventually you are just sharing profits at the end of the day?
Yes, that's the way it should work. The first 12% gets paid out once they are made whole. Say they put in 10,000, once they're even, then we're splitting any future profits, if any, 50-50 from there on. And then at some point in time, we'll liquidate the entire portfolio, discount it, and distribute any proceeds at that point.
And I think that brings up a real good point about what's the time period, the average estimate for, let's talk raw land, a turnaround time from acquisition to repackaging, repositioning, or resolving any of the outstanding issues and getting it for sale to potential buyers.
I think that realistic time frame is 18 months.
Okay.
Stuff happens all in the first 6 months. Mm-hmm. A lot of continued expenses with property taxes are going on. We have, in the case of the acreage tract with the mineral rights, we've incurred some additional expenses, hiring a landman, hiring a mm-hmm. attorney that knows, statutes regarding tax sales and mineral rights. So to answer your question, I believe, for example, the second property we bought that had an improvement is in a small town called Sinton, Texas. And it's in San Patricio County, a county seat, and they just opened a new plant there called Steel Dynamics. Big factory, lots of jobs, and 2 new subdivisions. This is a dried up, dead town called Sinton that some new plant came in, opened about a year ago, and created a bunch of jobs. There's 2 Horton subdivisions, D.R. Horton subdivisions going in this little town of Sinton. Well, we bought one house. It was real hidden, bunch of trees overgrown it. Bought it for $24,000, non-homestead. The story on this property is the former owners had deceased 5, 6, 7 years ago, and the grandchildren had been living in the property up until the Sunday before the auction on Tuesday. When they, according to the neighbor, after I bought it, I went there that day, and the neighbor told me, yeah, they left Sunday, went to West Texas, and believe it or not, Nate, they took the front door with them.
Oh, wow. I'm not surprised.
There's no front door, but they left about a $1,500 stainless steel refrigerator in the house. Anyway, we've spent probably $35,000 since May. New floor, new roof, new deck, kitchen, bath, and that redemption period's up November the 17th.
Okay.
We're going to be able to, we've got a $125,000 home on our hands now that we paid $24,000, and then we got another 35 in it. So somewhere around 60 in it, and it should sell for around 120.
And you're looking for 100% gain on a matter of a 12-month time period.
Yep.
That's
and
huge.
I feel comfortable spending the money on this improvement. One, it was needed. I mean, the floor was unleveled, the roof was in bare repair, and it's considered repair and maintenance. I heard the history of the children. Basically, they were squatters, even though they never go through probate. They really probably were entitled to the property if they'd taken the time and spent the money with attorneys to get their legal ownership.
Not if they're squatters. They're just hoping to get all that they can get for nothing.
Exactly.
So I know that is because there's a home there, there's a structure there. When we're talking about raw land, I mean, I know it takes 6 months, sometimes 12 months, once you get something under contract to actually close. And just so that everybody understands, why is it so different? Generally, a builder or developer wants to make sure that they have their building permits, that they have zoning. They call it the entitlements. Can they even build, or are there other rights, or is there a cloud on title that stops them from being able to build and sell? So a lot of these things just simply take time to organize. And that's where, if you're selling a home, maybe it's sold in a month or two. But if you're selling raw land, it can take up to a year minimum, even when it's under contract.
Or it can take as soon as a day. If you price it right and you have all the diligence done, and it's in an area that doesn't require zoning or this and that, there's a big competitor, a hedge fund out of Houston that we're bidding against in some of these counties every month. And their whole model, they're very successful. They buy and they owner finance the land and the structure. They do nothing to it. They don't even paint it or clean it or mow the yard. And they owner finance it, 12% interest. So, there's other just options to dispose of the property in a shorter time frame. But I totally agree. If it's a desirable piece that somebody's going to pay a desirable amount of money for, they're going to take time to do their diligence and be sure all the zoning entitlements are in place.
And I think you really nailed it with, if you can buy it for 20 cents on the dollar, heck, you can sell it for 40 cents on the dollar, still make 100%, and everybody comes out ahead. Mm-hmm. So it is just such a ripe market for investing, for really focusing on, and frankly, not a lot of people are doing it. So I really, John Burlett, really appreciate you coming on today and diving in a little bit deeper and sharing a little bit more about this area that frankly, not a lot of people know.
I'm super excited to have me on after all this time. I watch your podcast pretty regular.